move along to one of the companies and stocks I'm most excited about, as far as a auto supplier that is reinventing itself while using its core business to help pay for coming opportunities in electrification. We've got Dana Incorporated, which is a Maumee, Ohio-based manufacturer of powertrain and drivetrain and thermal products for a host of vehicle markets, namely light vehicle, SUV, and light truck, commercial vehicle, and off highway. They've got a great story with some real numbers and profitability behind it. The company has 144 million shares, trades around $23. It's a very good day today too. For about a 3.3 billion equity cap, about 2 billion net debt, for a total enterprise value of about $5.5 billion. We're joined today by Jonathan Collins, the company's chief financial officer, and Craig Barber, who is director of investor relations and also handles a lot of the M&A and corporate development there. So we're delighted to have them. They've got some slides, and then we'll get into some Q&A. So, Jonathan.
Great. Thank you, Brian and Mario, for having us. It's great to be back out in person and see some faces we haven't seen in a while. So thanks for having us here today. As Brian mentioned, I've just got a few slides I'm going to walk through at the beginning. The first thing I want to share is we had a really exciting event just a little over a month ago that we hosted at our world headquarters just outside of Toledo. You'll notice the person in the lower left-hand corner of the screen. He came and joined in person. So we had about 10 of our large shareholders that came in person and a number of other capital markets participants. And we really laid out the narrative around what is happening for Dana in the transition from internal combustion engines to electric vehicle. And for me, the most exciting part of the day wasn't just the PowerPoint slides. It was the ride and drive event and the technology showcase that we provided. So you can see on the slide in the upper left-hand corner, the real electrified axles that are on the road today were on display. And then we had the opportunity to bring a number of vehicles across all major mobility markets, light vehicle, commercial vehicle, and off-highway equipment we had on site. And people like Brian and others were able to test drive those or participate and see what the experience is like to be in an electrified vehicle, not just a passenger car. So that was a big event for us. What we did at that day is laid out for all of our stakeholders a very clear path to how we're going to create significant value for our shareholders through this transition from the combustion engine to the electrified vehicle. And it was really built around 8 key pillars. The first is the whole vision that we are moving towards is a zero emissions future. And we are attacking greenhouse gas emissions across all elements of our value chain. So scope 1, 2, and 3. And we laid out our plan there, which includes not only for our own facilities, moving to solar arrays, but also investing in virtual power purchase agreements for wind and for solar. And that's really the theme of what we're trying to accomplish. The second aspect is the growing addressable market. So today, the total addressable market for our electrified propulsion systems is about $2.5 billion. It's going to grow to nearly $19 billion by the end of this decade. And the next element is really why we're so excited about it is we've developed a very attractive moat around our electrified business. We can do something that a number of our other competitors are not able to, and that is produce all of the components needed to produce an electrified axle in-house. We have the motors, the inverters, and the mechanical competence. And probably what is most overlooked with our transition is the fact that every electrified vehicle on the road today, and every one that'll be on the road for the next decade, has an axle in it. So our core product doesn't go away in this transition. What's more interesting is it becomes significantly more expensive because the electrodynamics become embedded in the axle. So the motor that turns it will be inside of the axle, which means that our products are going to be about 3 times more expensive. And the profit profile for those will continue to improve because these are now smart systems. So previously the controls for the powertrain sat in the engine and the transmission. That power path management now comes into the axle and provides opportunity for additional margin expansion as we move through the transition. We also offer a very interesting play in electric vehicles in that we are providing these systems to both established OEs as well as emerging startups. And there's a lot of competition in electrified vehicles, and all of them are buying axles from Dana to provide propulsion for those vehicles. We're also also in a position where we can take this investment we're making and not only scale it across the light vehicle market, but that core investment in electrified axles is relevant for commercial vehicles and for off-highway equipment. So we can get a better return because of the ability to apply that technology to the entire mobility landscape. And then finally, Brian touched on this, but something very interesting for us is because our core product doesn't go away, the cash flows that it generates will be there on a consistent basis. There's no cannibalization of our products to help to fund this growth into the future. So we think all of these create a very compelling case to demonstrate that we're going to create great returns for our shareholders in the coming years. And this is just a touch on that core technology. So in the middle of the page here, you see what the electrified axle looks like. It draws not only on the mechanical capabilities you see in the lower left, and those come from our legacy brands of Spicer and Graziano, but it also takes the electric motor in the upper left, the power electronics in the upper right that control that, and then the software and the controls that are managing that system as well too are all embedded in these systems that are going to be 3 times more expensive than the drive lines we produce today at a higher margin profile. The best way to demonstrate it's working is, if you will, the proof is in the pudding. All customers across all of our major mobility markets are selecting us. So these are a dozen new electrified wins that we announced at our investor day across the off-highway market. You see customers like Komatsu and Taylor. You see in the commercial vehicle market, Navistar, PACCAR, and a couple others we couldn't touch on quite yet. And then we have some new customers in light vehicle that are using our systems, not able to disclose those customers yet for electric axles. And then for battery cooling, something you guys are talking quite a bit about today, a big component of the system is batteries. They have to be managed thermally. So customers, GM, Ford, Rivian have all selected Dana to produce battery cold plates for them. And then as well, our power technologies business is producing bipolar metallic plates for fuel cell stacks that Bosch is going to use and supply to Nikola in their Tre Class 8 truck. So I'll step back from the future and just talk a little bit about the environment we're in today. We put this together. We thought it'd be a little bit helpful. The macro environment right now is pretty challenging, and there are really 2 things that are causing some near-term pain. And the first is inflation. So on this top chart, we just indexed SBQ steel. It's the primary steel that we buy, and freight rates, and we show they're pretty stable for 2018, 2019, 2020. And then obviously in the last 9 months, we've seen a dramatic increase in these costs. We're in the process of working to recover those with our customers for commodity prices. There's a bit of a lag there that puts pressure on our margins in the near term. But as you can see, the 2 external parties we looked at, IHS and FTR, both are expecting those to abate mid next year and come back down to more reasonable levels by the end of next year. The other major driver is the constraint of chips, which you're all well aware of, but you can see we just picked a good proxy for us is full frame truck production in North America that was hovering around that quarterly rate of about 1.2 million units. You see that blip there during the midst of the pandemic in the second quarter of last year, but we've actually seen a bit of a decline this year as they're struggling to get access to chips to build those important vehicles. We think we're likely going to be in this condition for a few more quarters, and it's probably going to be towards mid to the end of next year where we start to see that abate and we're able to get to a better position. The good news is that demand for our products is incredibly robust. Dealer inventories have never been lower. Back orders for large trucks have never been higher. Equipment availability is very low. So once they're able to secure access to the supply, we think we're going to see a very strong and robust cyclical recovery. And that's reflected in the upper right of this slide. So at our Capital Markets Day, we highlighted the business that did just over $7 billion last year. We expect to grow to north of $10 billion over the course of the next couple of years. That represents about 45% growth, largely driven by a very strong cyclical recovery. But if you look beyond that, our electrification business will contribute about $700 million. And those are real electrification sales. They're booked sales on real programs that are going to come to fruition in the next couple of years here. But we expect it to quadruple again by the end of the decade. And we expect the electrified business within Dana will represent about a quarter of our sales and be about $3 billion at that point. And as I said, we expect really strong margin profile in the latter half of the decade as volumes get to a critical level and we can start to get a really good return on the investments that we've made. So we think the future is very bright for us. We've got a very strong cyclical recovery and a great secular growth story coming as we move out of these challenging times that we're seeing right now, hopefully within a few quarters here. So Brian, those are the prepared remarks we had. I'd love to take questions you have.
So let's get started with electrification process. This is a business that's largely been born of the acquisitions that have been made by you and by Jim since he took over about 5 or 6 years ago. Maybe take a few minutes just to kind of walk through the major components of that EV M&A roll-up strategy and how that leads to kind of a holistic view of what you can do now.
Absolutely. So we identified about 5 years ago that the way to develop the most attractive competitive differentiation in electric propulsion was have in-house capabilities, not only for the mechanical components that we've been producing for 100 years, but it's really these electrodynamic components. So the electric traction motors, the power electronics modules, the power inverters that control the motor, and then also the software and controls that manage the system. So we acquired a controlling stake in TM4, which brought us high voltage motor capability and permanent magnet topology. And that's going to be for all of the larger applications, large trucks, large equipment. Shortly thereafter, we acquired the entire business in Italy, a company called SME that had great low voltage motor capabilities. They also had induction motor topology and synchronous reluctance. So these are other motors types that are used for different power requirements. That really gave us an entire broad range of capabilities to put a motor inside of any axle or drive system that a customer may need, and the inverter capabilities to manage that system. So that was really the guiding principle. We've done some tuck-in or smaller acquisitions in the last couple of years. It's largely been to give us software and integration capabilities because our customers now need these systems to be smart systems. So a couple of examples there include Rational Motion, and then also Nordressa, company that we acquired. So these are a number of other businesses that help to build out that capability. But what that's really done for us is taken our legacy mechanical capabilities, these electrodynamic competencies to deliver these full electric propulsion, and it's working. The customers are really pleased with the solutions we're providing for them.
The battery, the thermal capabilities are really from Cordana. It's not necessarily something that you acquired. Talk about that opportunity, how it relates to different battery chemistries, the fuel cell opportunity there, and some of the products and maybe the content as you range from a typical light truck on the. I know you're not going to give me exact numbers, but on the F-150 Lightning to maybe something like you'd see on the Hyliion product.
Yeah. So to your point, our power technology segment is a minority of our business. It's unique to Dana. 85% of what we do in the business is drive systems or drive lines for light commercial vehicle and off-highway. Power technologies has two competencies. One is thermal management, and the second is sealing capabilities. The thermal management capability is used to cool engine oil and transmission fluid in an internal combustion engine vehicle. That same competence has been leveraged to use the glycol loop in a vehicle to be able to cool a battery. So we have battery cold plates that sit underneath the batteries that help to manage the thermal properties of the battery. And these represent a pretty significant content increase. So we highlighted the combination of not only the battery cooling, but also the bipolar metallic plates in the fuel cell stack lead to about 3x CPV. So you can imagine, coolers for engines and transmissions are $10, $20 a piece, and obviously significantly higher for battery cooling. On the sealing side of power technologies, these cold plates help to catalyze the electricity that's being created in the stack. And this leverages our sealing capabilities to keep the fluid where it needs to be inside of the stack. So that's another one. Really excited about what we're doing with Bosch there and some of the other customers that'll be coming down the line. But those capabilities are the one case where we're taking a competence in parts that were previously in the vehicle in an internal combustion engine and leveraging those for electrification. And it's becoming a big differentiator for us, a great growth opportunity. And as you noted, it's all organic. This is something that we've had in the business, a competence that we've leveraged for electrification.
You've taken up your market share projections for some of your core markets for EVs, most notably areas like light duty truck, medium duty truck, construction equipment. What do you think is driving this? These aren't necessarily gross numbers. These are market share numbers. There's demand pull. What do you think is driving it?
Yeah, it's two factors, and we tried to lay this out just a few weeks ago. The first factor is the market continues to grow faster than we expect. So every time we draw a line in the sand and anticipate the curve, that line continues to accelerate. And we tried to touch on some of the key figures. It's investments in infrastructure, it's regulatory pressures. These are causing the market to move quicker. So the pie is bigger. But the second thing that I would say has been a pleasant surprise is the win rate we've had, particularly in the heavy vehicle market. So when customers are looking to outsource these propulsion systems and come to Dana, they're looking for a complete solution that's fully integrated. And these in-house capabilities have proven to be really valuable to the customers. The technology has been on the road for a long time. So TM4 has had electric motors and inverters on the road for well over a decade. It's very proven technology, and the customers are finding that the technology is fantastic, the cost is competitive, and it's a really good solution. So it's a combination of market growing a bit faster and us winning more business than we originally anticipated.
One of the things you're always up against is whether an OEM will decide to insource their powertrain decision versus outsource. Talk about that as it relates to electrification, maybe and maybe relay it as it relates to your core products, F-150 in-house versus heavy duty. Being a core Dana product.
Yeah, that's the flagship example that usually when we share, the light goes on for most people. So a meaningful portion of all axles and drive shafts that are produced today for internal combustion engine vehicles are built in-house. And the customers choose to outsource a portion of the business. We see that's going to be very similar in the future. And we actually created a construct that we shared at our Capital Markets Day where we highlighted typically programs that have higher volumes and fewer variants tend to be insourced, and programs that have relatively less volume and a more larger number of variants and more engineering complexity are often put on the outside. And the perfect example is what our largest customer chooses to do in light vehicle, where they produce the F-150 axles in-house in a facility they have in Michigan, and we produce the F-250, 350, 450, all the way on up to the 650 and 750 in a facility in Kentucky. So that's a perfect example. And we think that trend is going to continue as we see the quoting activity where we engage with customers and are winning business in all of our end markets. We see a general pattern playing out, and we believe that's going to be there as well too. So I think the insourcing is true. The issue is people may not recognize that's the way it's been for quite some time.
I hate to ask the Michigan State question, but if you won, somebody lost.
So the boss is a Michigan State grad.
I know.
So
I know.
yeah, if you, I'll give him credit.
I figured the Ross School was in there somewhere.
Yeah, that's right.
But who's losing? Is that the in-house company that does it itself, or is it the I'm going to use the name Allison or someone like that?
Yeah.
How much of that is public information that you could share?
Yeah, very little, but we have intoned, Mario, we've given a sense that the competitive environment has changed a bit. So some of the folks that we've, gone up against in the past, there's certain cases we see in, but there are some new folks we see. And what we've really tried to highlight is we see the capabilities of having all of these components in-house. Those are the most formidable competitors. So we haven't won everything, in the last couple of years. And when we lose, it's typically to someone who has those capabilities. And obviously in the cases where we're winning, the feedback we're getting from our customers is the ability to provide the entire system is incredibly important to them.
Thinking about the near term, supply chain issues amongst a host of other problems right now. What do you think the long-term implications of this are on Dana as a supplier, along with the supply chain in general, as it relates to the amount of working capital, the amount of safety stock, and how you negotiate with your customers?
Yeah, it's an excellent point. We get asked quite a bit. Is this going to change the complexion or the comportment of the supply base with respect to distances? I mean, the reality is, in order for us to be competitive in this global economy, we have to leverage, the best cost around the world to make these products at the best cost that we can for our customers. So we believe that will continue. We're not going to bring everything into the U.S. per se. We've become much more vigilant on working with suppliers to understand their stability, what things we can do in terms of lead time to help them. We're working with our customers to highlight ideas and ways that we can provide more stability. The reality is, the biggest challenges, apart from our customers' inabilities to get chips, but when we struggle with the supply chain, a lot of it has been around pandemic outbreaks around the world, and these are things that are you can in some cases see coming. In other cases, it's difficult to know where the next hot spot is going to be. So I would say there's heightened vigilance, a lot more leveraging analytics and data to make sure we're looking at the right elements of the supply chain and working with suppliers to mitigate risk. But we can't suggest there's going to be a wholesale change in approach relative to where we get our materials going forward.
Similarly, as you think about what Dana looks like after all of these issues are behind it, lessons from COVID and maybe how you might be a structurally more profitable entity down the road just because of what you learned from what you've had to go through for the past 20 months.
Yeah, it's an excellent point, Boyd. It not only affects the front end of the business, but the middle and the back end as well, too. I mean, we think about how the cost structure could evolve in the future, knowing what we're able to accomplish virtually or leveraging technology. So we're continuing to look at ways where we can refine our overhead and our SG&A associated with cost savings that we've learned to manage through the pandemic. When it really gets down to the core element of our business, though, we have been able to accelerate and drive the pace of innovation when we've been working digitally over this period. So one of the things that's interesting about us is we have technology hubs that specialize in certain areas of electric vehicles around the world, and the ability of those teams to continue to work together and drive forward to bring new technology to market that's tested, validated, and proven has been fantastic. So we've looked at it on the front end of our business in our manufacturing operations, the scenario planning, the additional work we do to make sure that we're going to have the parts we need in the right regions. So I would say it's affected a lot of the areas of our business, and I think we're going to come out of this with a very robust demand and some great lessons learned to be able to drive stronger profits and cash flows in the next few years.
You made the decision to walk away, or whether mutual or otherwise, from the Modine business that you were looking to acquire or to take on. And I'm curious, where does that leave you now? Is this a technology that you're really desiring, that you're going to look elsewhere for, or is this just something that you'll move on and do something differently?
Yeah, it's a fair point. This is the best example of an opportunistic transaction. So we were going to take the business on, virtually we were going to pay nothing for it. There were meaningful cost synergies, and it brought some complementary geographic and commercial presence for us. So they're stronger from a thermal standpoint in Europe, and we thought that was great, and we thought we could get $30 million of EBITDA for free. So the reality is, when the regulator pressed on market share in Europe, the German regulator, what we'd have had to do to the transaction wouldn't have delivered the same value. So we maintained discipline and said, look, it's not the deal that we were willing to do. Because it was opportunistic and wasn't filling a strategic hole, it made a lot of sense for us to just move on and focus on some other areas.
Just some of the individuals that are listening on this call that were not privy to what you said at your earnings release. Can you kind of echo what you said for 2022 and beyond? And then secondly, when you look at it, you had a slide there that had Rivian so likely projected a market. Nothing wrong with this. I'm just coughing. $80 billion, and yours is $3 billion. I always wonder what you have in your business model that could attract even more attention. So step one is, what did you give as kind of the numbers for 2022, 23, and beyond?
Yeah, absolutely. So the focus for us is a couple years out. 2023, we think, as we indicated there, we're going to see raw material costs start to abate to more reasonable levels. Production is going to ramp up as our customers across all markets get access to chips. So that's going to lead to what we believe is going to be over $10 billion of sales. Profit margins for us should be around 12%. We did 11.8% in 2019 on lower sales. But what we've been continuing to do in the next few years is ramp up the rate of investment in electrification. So what we said at that day is Electrification investment is going to be about 100 basis point headwind in 2023. So we'd be at about 13% if it weren't for the meaningful investment in electrification. And the valuation comment you highlight, Mario, is the real reason that we're focused on that. So we're going to have a business that's a $700 million electrification business in just a couple of years. And if you look at some of the revenue multiples of these businesses, that's a pretty valuable business on its own. And then our core business, as we highlighted at that investor day, is going to continue to grow at a reasonable trajectory because, again, the axle doesn't go away in an electrified vehicle. So we think the value proposition of having this electrified growth business being funded by a traditional business that's not going away is really compelling from a valuation perspective. And we're trying to draw attention to all the things that we're doing in electrification to help appreciate that.
So last question here with about 90 seconds to go. 1.2 billion in EBITDA or so, 2023, throw off a lot of cash despite the massive investment in electrification. Talk about cash flow priorities and what you see as from that perspective.
Yeah, we see a path to being able to generate upwards of $1 billion of cash flow over the next few years. So it's going to be softer this year because of the investment we're making in inventory. But as working capital normalizes in the next couple of years and that profit conversion comes on, we think that's going to be a pretty attractive cash flow over a 3-year period. And from our perspective, there are a couple of things we would like to, obviously we'll continue to pay our dividend, a dime a share quarterly. We have a stock repurchase authorization that we started to work on back in the third quarter. We bought back about 1 million shares of stock at a pretty attractive price in Q3. We'll also leave a little bit of dry powder for M&A that will continue to enhance our competitive position. And then we indicated we think we'll use about half of the cash to delever. The higher EBITDA and about $500 million of delevering in the next few years will get our net leverage to just over a turn. And for us, we think that's a really attractive and compelling cap structure on a go-forward basis. So that's how we're thinking about it. We'll obviously continue to look at where the market is and be flexible over the next couple of years as well.
Great. Well, we're bumping up on time, but Jonathan, Craig, I really want to thank you for your continued support, particularly in person this year among any. Thank you very much.
Thanks for having us.